Righto, thank you everybody. Kingsley Smith from RWK Accountancy with my fellow director here, Phil McCredden, with an update we want to do on the budget from last week. Talking about, I guess, some of the little trips and traps and landmines that might have slipped through the net. There's obviously always the talk about all the wonderful aspects of the budget, all the selling points, but often there's a bit of the old devil in the detail, and we'd like to just bring that to people's attention with this bit of a video we're going to do now. Mostly we'll be talking about the instant asset write-off, but we'll talk about a couple of other things that perhaps not traps, they might well be more opportunities perhaps, but we'll talk about those with the tax bracket changes and so forth. But probably the first thing we want to talk about is the depreciation part. Mostly everyone would have heard, of course, that you can do this buying something worth up to $150,000 and be able to write it off immediately. So in this tax year, so if you bought a $150,000 piece of equipment, you are going to get $150,000 worth of depreciation that you can claim. I guess what we need to also make people aware of that situation has been around for a while for the small businesses, which is most of the people probably watching this. And has been fairly fast depreciation even before that. So, Phil, I guess that, over to you now in terms of what we see are some of the traps there, particularly around where we have written stuff off very, very rapidly in the last 12 months, maybe even getting on to 2 years now. What are some of the traps you're seeing could be looming out of that?
Yeah, King, so I suppose with the introduction of that 150 write-off, a lot of your small business clients that had asset pools probably written them off at 30 June 2020. So, unless you had a significant number of assets on your balance sheet, potentially that balance has already been written off. And of course, that means later on down the track, not only have you lost the you haven't lost it, you brought forward the depreciation, I guess. So so we need to take into account the fact that the depreciation, the immediate write-off is once that depreciation's gone, it's done and dusted. So in future years, it's gone. But also when that means the written down value when you trade the asset in or you sell the asset privately, that's zero. So effectively the proceeds on the disposal of the asset are accessible in full. And of course, typically there's GST that needs to be remitted on the sale of the asset. So I guess that needs to be taken into account in terms of planning the disposal. It's not, there are tax consequences to be considered there.
Because I guess it's probably particularly nasty for people where they've just decided to sell one of their, they're selling an excavator they don't need or anything in isolation. They're not going to do a trade or anything. In that case, they need to be checking that if they're about to sell it for $30,000, it might be that has been written down to zero, is what we're saying, or their pool's all gone, and that's going to be $30,000 of profit.
Yeah.
And then we have the other situation, more typically, I suppose, with probably people who are doing a trade-in and they're about to buy the $100,000 new item and they're very focused on the $100,000 they're about to be able to write off, but they're forgetting that the trade-in's full revenue, full profit offsetting that, aren't they? It's and we often see that with the GST too, that people forget to put the GST on their trade-in as well. And then they sort of... they should have traded it for 33,000, and then they find they're not netting 30 grand out of the trading because the taxman's got his piece as well. It's a nasty little surprise. So it's just getting people to realise that's there. I suppose the other thing too is even if you're not buying a lot of gear through this period, as you say, it may well be your depreciation. You used it all up last year, isn't it? So I can think of our clients that are fairly capital intensive businesses where last year depreciation might have been one of their biggest deductions on their tax return. This year they won't have one. And they're going to be, if they have a similar year, they think, well, how come my tax bill's so much higher this year? That's what they're not, because depreciation's just a non-cash book entry that we do. They don't have any sort of sense of it. So hopefully people will watch out for that. What about on the, you're going to buy a, fancy Land Cruiser or something like that, Phil? You see any traps around that? You're going to buy the Sahara, $130,000 Sahara. We're going to pick up $130,000 deduction. Is that, you see any traps there?
Yeah, so we're still, even though the limit, immediate write-off limit's been lifted to 150, and I should probably mention, so that what we're talking about was the initial set of legislation that went through, with the COVID, I guess, induced legislation. But then on top of that is also this, people would have heard in the budget, this unlimited write-off for businesses under 5, with turnovers under 5 billion, and that would be probably most of your clients, Kings. So this is actually sitting sort of as separate legislation. So for businesses that small businesses now, effectively to 30 June 2022, have the option of either that 150 or ultimately anything higher than that. But back to your question, so your motor vehicle limit still applies in both of those cases. We're still capped at it's 59,136 as a depreciation limit. So if you get your nice Sahara for 150, well, you can only actually depreciate for tax purposes 59,136, and the GST claim on that is 1/11th of the 59,136. So so that would capture sort of cars, I guess. So unless the vehicle falls outside the definition of car in the Income Tax Act. So that would be for vehicles that are designed to carry more than a tonne or nine passengers or more. So those sorts of vehicles, they're not subject to that limit, that car limit. So, there might be cases where you get a 1 tonner or something that, that is a workhorse type vehicle that falls outside the scope, and therefore you are able to write off the amount above the 59,136.
Yeah. And I guess it's just, making people aware again of that sort of, if you're buying in a sense of a fairly fancy spec'd up vehicle, probably you're going to hit that problem. As you say, if it's a base model that's more around real work and on the 1 tonner, then you're probably safe. But just do your homework and check, particularly if the fast depreciation is one of the main reasons you're buying it. I guess the other thing too is at all times, whether it's at the moment where there's all this very fast depreciation, or even back a few years ago when it wasn't quite so fast, is in the end, all you are getting, you're just getting your depreciation fast. You're not getting more, and you're only saving some cents in the dollar. It's if it's a company buying a piece of equipment that and it's a trading company, I guess they're going to save, say, 26 cents in the dollar. So spend 100,000, but your tax bill's only going to come down to 26,000. So you still have a very good commercial reason as to why you're buying that piece of equipment. The tax thing doesn't suddenly make, in a sense, almost stupid decisions suddenly make sense. It's still got to be a useful piece of equipment, and you're going to get a lot of work out of it.
Especially those, your Sahara type cars, because obviously you're only getting the depreciation on the 59,136, but then fringe benefits, tax consequences are on the full cost price of that. So you might find that you get stung on sort of your private luxury vehicles that have been put through your company. I guess the other thought I had on, the bring forward deductions are good in terms of that, at the moment, the company tax rate is going down. I guess it sort of ties in with the reduction in personal income tax rates as well. So by bringing it forward, the overall tax benefit is probably going to be slightly greater because we're getting the deduction at the higher tax rate.
Yeah. And I suppose in a sense that's a useful little bit of a segue to the other couple of little things we wanted to chat about. I guess particularly, Phil, I wanted to just raise with you that often with our clients, and particularly when we're talking about the owners, we will have them on wages often set at the tax bracket limits. So at the moment, there'll be some business people out there that they've given themselves a wage at the old 37,000 a year, or perhaps the 90,000 a year. But of course, we've had those brackets lift. So any sort of views around that, Phil, as to whether people should be looking at doing a rejig?
Yeah, I suppose, those tax brackets have moved. So where it was sort of between 18,200 and then 37K, as you mentioned, you're paying 19 cents in the dollar plus the Medicare levy. And then from the 37 to 90, you were paying 32.5 cents plus the Medicare levy. Well, that bumped both of those up. So it's 18,200 to your 45 is 19 cents, and then your 45 to it's 120 now is just 32.5 cents. So then the next jump up goes to 37 cents. So there is an incentive, particularly if there's a lot of money coming out of the company, potentially to treat it as an increased wage, rather than for example, a loan on the balance sheet or some alternative. So so effectively there's a tax break for, and not everyone's happy about it, but you're sort of the higher income earners, I suppose.
Yeah. And I suppose the only thing we'd just say there to anyone out there that's thinking of taking advantage of that, probably just make the quick phone call to us, because there are other things like payroll tax and whatever else that might slow you down on doing that. Just make a quick call and just make sure that you're not tripping on anything else. Yeah. And then the only other thing I guess I was just going to raise, Phil, was the carryback losses for companies. At this point, it appears to be only 4 companies. I think that's something that people need to realise. If you're running currently through a trust, there's no joy in it for you at this point. I see there's a little bit of political pressure building around that, so maybe that'll change, but so far it's the company. So, I mean, I guess it's just for people that it's the old, currently, of course, you have that situation where, let's say in year 1, you made a $50,000 loss, and in year 2, you made your $100,000 profit. Well, that's been great because we can say, oh, beauty, we can take that $50,000 loss you made last year and take it off this year's $100,000 profit. It was the other way around, and you'd made the $100,000 profit in year 1, and then the loss in year 2, you were stuck. You couldn't say, right, well, let's take one off the other and even it up. Now, with the new laws, they will be able to do that. So I can't see any great traps in that unless you know some other things, Phil, but that seems to be a good look.
No. Yeah, so I guess all I'd say is that it does run for sort of only 3 years, so it is a temporary. And similarly to when there was that carryback loss legislation in a few years back. So it's got a limited shelf life, and I guess, it is really, because actually, we're finding that for me particularly, finding some of our clients are doing okay. I have done okay thus far, and they've got, of course, with JobKeeper and that sort of thing coming in on top. So they might have actually had a profitable, say, 2020, but once the full effects of all the government sort of pulling back on spending, is felt, then it could be that actually they do end up in, lost positions, and maybe it was sort of, the profit from the prior year was a little bit artificially inflated. So it's, it's good for, like I say, companies only. So sole traders and trusts don't have access to it, but it does seem a bit unfair, I think, for your small business.
Yeah.
So we'll see.
Yeah, we will. And that's, I guess, about all we wanted to sort of cover off about making this too as fun as exciting as it is. So it's a doable size for people to digest. They're the key things that we've seen out there that probably haven't got the press that perhaps maybe needed to, and just to make sure that people understand there's the good bits, but just be aware of the stings in the tail. And hopefully all of our clients will be very well informed and won't step on any of these landmines. So until next time, thanks for watching, and hope you don't step on those landmines. Give us a call.